Hi there, Jeff here with a video on the UK economy. Let's spend a few minutes thinking about the investment gap. Well, this chart's important. It shows gross investment, total capital spending, as a share of our national income. And you can see that having fallen dramatically during the global financial crisis, investment did pick up in the early part of the 2010s, reaching 18% of GDP. But since then, since the last 8 to 10 years, it's flatlined below 18% of national income. Indeed, the latest figures are that the UK invested just under 18% of GDP in 2024. Now, that is a low rate of investment, certainly compared to other advanced economies, and it has implications for long-run performance. In particular, the UK's investment rate is below that of many other G7 countries. In fact, it's the lowest. And of course, massively below, less than half, the investment ratio of China, which at the end of 2023 was investing, as it has done for many years, around 40% of their national income. Their investment ratio is extremely high, one of the highest in the world, and reflects its emphasis on investment, otherwise known as capital formation, and infrastructure in particular as a key driver of economic growth. You can clearly see on the chart here, taken from the World Bank data, how the UK lags its G7 peers, and especially behind China, which is not in G7. China's in a different league when it comes to investment intensity. Now, this chart just shows G7. Okay, so Canada, France, Germany, UK, Japan, the UK and the United States. And I've deliberately put the UK there in a bold green. And you can see that in 2024, we were quite some distance below other countries in terms of our investment as a share of national income. It looks like Canada came top, Japan came top. So why is there an investment gap? Why is it the UK persistently underinvesting? Well, one reason is, despite what other people might say, it's Brexit. We voted to leave the European Union in 2016. We left the EU in 2020. The UK has continued to attract high levels of foreign direct investment coming in to the UK, but overall, Brexit has created prolonged uncertainty and in many cases has reduced businesses' willingness to commit to long-term capital investment. And wider fiscal uncertainty, in particular rates of corporation tax and tax allowances, has also undermined business confidence. The UK typically, overall, has underinvested in state infrastructure, public infrastructure like public housing, transport, energy and digital. And austerity policies post-2010 certainly significantly reduced public capital spending. That's something that Labour is trying to address. Relatively low demand growth also hits investment. So domestic demand, consumption, investment and exports has been fairly sluggish. For many, many years, people have seen their real wages either flatlining or falling. So demand growth has been weak. Of course, consumption is a big part of UK GDP. And when demand isn't growing very quickly, that dampens the incentive for businesses in many different industries to expand supply capacity. And there's a wider issue about short-termism in the financial and business sector. So the UK capital markets tend to be geared towards short-term returns, especially when you have private equity involved. And corporate governance models often reward shareholder payouts in the form of dividends and share buybacks instead of reinvesting profits to fund investment. And there are also wider issues to do with regulatory and planning barriers. So planning delays and land use regulations for new housing, new infrastructure have in the past made investment in key sectors more difficult and costly. So there's quite a few reasons why the UK underinvests. There's no silver bullet. Why does this matter? Well, the answer is it does matter. Low investment tends to hit productivity. So you need capital investment in new machinery, new plants and technology, better infrastructure, so that businesses and firms and workers can operate at the cutting edge of technology. Without it, the UK has less capital per worker to work with and an ageing capital stock. So labour productivity tends to suffer. And our infrastructure also acts as a barrier to faster productivity growth. And if productivity growth stalls, that limits wage growth and real living standards. Investment's important for innovation and competitiveness. So we need investment in research and development, digital technologies, automation to help British firms stay competitive globally. So falling behind risks the UK losing out in higher value industries and also helps to explain the large trade deficit. We tend to be a nation of consumers rather than investors. Poor infrastructure, including dilapidated transport, intermittent energy, slow broadband, that raises supply costs for businesses and reduces connectivity. And it inhibits regional levelling up and regional long-term development. And crucially, if we're not investing enough, the economy's long-run aggregate supply, long-run productive capacity is held back. And if growth is weak, as the government is finding at the moment, tax revenues suffer, and this then limits the fiscal space and the ability to respond to future challenges, including, obviously, climate change and the challenges of an ageing population. Well, Labour is committed to trying to increase investment. The proof of the pudding, of course, will be in the eating. They've established a National Wealth Fund designed to attract private investment into key sectors, initially funded with about £6 billion worth of money, just a drop in the ocean compared to the sovereign wealth funds in Norway and China, for example. But they're trying to use the National Wealth Fund to fund investment in green initiatives and try to bring the private sector in as well. Crucially, Labour is trying to reform planning, to increase house building, to increase investment in construction, and they want something like, well, they want 1.5 million homes by the end of this decade, which involves a lot of extra homes each year. And the government's also committed to increasing public investment by around 1% of GDP in sectors such as energy, transport, housing and industry, so try to address the infrastructure gaps. But of course, all of this money has to be funded, and at the moment, with defence spending under pressure and other factors as well, the government is being limited in what it can do. So, a quick recap. There is a big investment gap. The UK invests less than 20% of its GDP in new capital. It's 18%. That is well below countries like Australia, South Korea, Germany, India, and of course, we mentioned China. So it's worth knowing about this investment gap. It does lead to supply side problems for the UK, especially in international markets. Okay, thanks for joining in.